In the world of investing, success is rarely about luck. More often, it is the product of discipline, strategy, and consistent habits that compound over time. While two investors may begin with the same resources, one may grow wealth steadily while the other struggles, loses confidence, or even exits the market altogether. What makes the difference? The answer lies in their financial habits, practical, repeatable behaviors that influence decision-making, risk management, and long-term growth. This video explores the top 10 financial habits that consistently distinguish successful investors from those who find themselves stuck, confused, or losing money. Whether you're a beginner or someone trying to break past a plateau, adopting these habits can dramatically improve your financial journey. 1. They set clear financial goals. Successful investors always start with a destination in mind. They don't invest randomly or emotionally. They know exactly why they're investing, whether it's for retirement, a child's education, or building generational wealth. These goals are smart, specific, measurable, achievable, relevant, and time-bound. Clarity allows them to choose the right asset classes and risk levels, align their investments with timelines, and stay focused even when the market fluctuates. On the other hand, struggling investors often lack this clarity and end up reacting to trends or media hype without a structured plan, making them more vulnerable to losses and missed opportunities. 2. They educate themselves continuously. Successful investors never stop learning. They read books, follow financial news, attend webinars, listen to investing podcasts, and learn from both their successes and mistakes. They understand economic indicators, how interest rates affect markets, and why certain sectors outperform at different times. This knowledge empowers them to make informed decisions instead of blindly following tips. In contrast, struggling investors often rely on hearsay, social media trends, or outdated information. They may jump into investments without understanding them, leading to poor asset allocation and emotional decision-making during downturns. 3. They follow a consistent investment strategy. Discipline is the backbone of successful investing. Top investors stick to a well-defined strategy, whether it's value investing, growth investing, index fund investing, or dollar-cost averaging. They understand their risk tolerance and investment horizon and rarely deviate from their plan. This consistency protects them from impulsive moves and helps them ride out market volatility. Struggling investors, by contrast, often lack a coherent strategy and are easily swayed by market noise. They might buy high and sell low, chase the latest, hot stock, or jump between strategies, which prevents any long-term gains from taking root. 4. They prioritize long-term thinking. One of the most critical habits of successful investors is thinking long-term. They understand that wealth creation takes time and that compounding works best when left undisturbed. Instead of panicking during market downturns, they see such moments as opportunities to buy quality assets at a discount. They don't obsess over daily price movements but focus on long-term trends and fundamental value. In contrast, struggling investors often seek quick wins. They may be lured by day trading, speculative investments, or trying to time the market, which usually results in losses or inconsistent results. 5. They diversify their portfolio. Successful investors never put all their eggs in one basket. They understand the importance of diversification across asset classes, stocks, bonds, real estate, commodities, etc., sectors, technology, healthcare, energy, etc., and geographies. This reduces overall risk and provides stability even when one asset underperforms. They also rebalance their portfolio periodically to maintain their target allocation. On the flip side, struggling investors often concentrate their investments in a single asset or sector, increasing vulnerability to volatility. Lack of diversification can lead to catastrophic losses when that specific investment goes south. 6. They control emotions and avoid herd mentality. Emotional discipline separates amateurs from professionals in investing. Successful investors manage fear and greed, two emotions that drive poor decisions. They don't panic during market crashes or get overly euphoric during bull runs. Instead, they stay rational, assess the facts, and act based on logic and data. They're also immune to herd mentality, resisting the urge to follow the crowd without doing their homework. Struggling investors, however, often let emotions dictate their actions. They might sell during a dip out of fear or buy into a bubble due to FOMO, fear of missing out, often to their detriment. 7. They track and review their investments regularly. Monitoring performance is key to investing success. Top investors routinely track their portfolio's performance, analyze what's working or underperforming, and adjust accordingly. They use tools or spreadsheets to track returns, dividends, expenses, and asset allocation. Reviewing helps them spot issues early, take profits when needed, or cut losses when an investment no longer fits their plan. In contrast, struggling investors often take a set it and forget it approach or constantly check prices without any strategic follow-up. Without periodic reviews, they miss rebalancing opportunities or continue holding underperforming assets. 8. They minimize fees and taxes. Successful investors understand that investment fees and taxes can quietly eat into their returns. They choose low-cost index funds or ETFs when appropriate and avoid frequent trading that incurs high brokerage charges. They also use tax-advantaged accounts like IRAs or 401ks and employ strategies such as tax loss harvesting to minimize tax burdens. Over time, even a 1% difference in fees can significantly impact portfolio growth. On the other hand, struggling investors often overlook these costs. They may invest in high-fee mutual funds, ignore capital gains taxes, or trade frequently without a clear cost-benefit analysis, which reduces their net returns. 9. They maintain healthy financial habits beyond investing. Top investors treat investing as just one part of a broader financial lifestyle. They budget effectively, live within their means, have an emergency fund, and avoid high-interest debt. These habits ensure they can invest consistently and avoid dipping into their portfolio for sudden expenses. Struggling investors, however, often lack these foundational practices. They might be investing while still carrying credit card debt or lack a rainy day fund, forcing them to sell investments during market lows. Solid personal finance habits create the stability needed to be a confident, long-term investor. 10. They seek professional advice when needed. Even the most successful investors know when to seek help. They consult financial advisors, tax professionals, or estate planners for complex decisions or long-term planning. This doesn't mean outsourcing all decisions, but rather ensuring they're backed by expert insight. Good advisors help them stay on course, optimize portfolios, and avoid costly mistakes. Struggling investors, in contrast, often avoid professional help due to cost concerns or pride. This can result in poor tax planning, unsuitable investments, or missed legal considerations, mistakes that could have been avoided with guidance. While investing can seem like a mix of numbers, charts, and predictions, the true difference between success and struggle often lies in daily habits. The most accomplished investors are not necessarily the smartest or the richest, they are the most consistent. They set clear goals, educate themselves, stick to a strategy, and maintain emotional discipline. They diversify, track their progress, control costs, and take a long-term view. Most importantly, they live financially responsible lives beyond their portfolios. By adopting these 10 financial habits, anyone, regardless of starting point, can shift from struggling to succeeding in the investment world. The journey may not be quick, but with the right habits, the destination is well within reach.